Let's get across the market open now. David Lane joining us from Ord Minnett. David, welcome to Wednesday. My goodness, you take a look at those moves on global markets, in particular Wall Street overnight, in response to, well, talk from both sides potentially of a de-escalation of the conflict in the Middle East.
Yeah, that's right, Andrew. It seems to be that constant daily morning look at what happens overnight in the US, and then the US market reacted very, very positively. Not as strong in Europe, but those talks seem to come to a fruition later in the day. But I guess the encouraging thing from our perspective is that this time we've actually got not just discussions from the US and Iran, but we've had the European Union get involved, as well as China and Pakistan have put forward a 5-point peace plan, which includes an immediate ceasefire, or a call for immediate ceasefire, and the opening up of the Strait of Hormuz. So a little bit of, I suppose, expectation that there could well be a more solid resolution rather than just relying on Donald Trump's Truth Social posts.
Yes, well, as he's pointed out too, look, essentially they've created the mess, and he's saying, and you guys can clean it up, because he says you can get your own oil.
Yes. Yeah, exactly. Yeah, and encouraging people to have a bit more confidence and to try and push through the strait. But as we know, shipping companies aren't necessarily going to do that, because they're not in business of being in war, and also the insurance costs are fairly high. So shipping companies need to have some truth that will actually be able to get through. So hopefully we'll see a bit more of a peaceful resolution in the not too distant future.
So as a consequence, we are expecting a higher open here, although look, SPY futures up around 1.5%. You compare that with Wall Street. I mean, the Nasdaq absolutely soaring. So just a little more muted here.
Yeah, I think we will be a little bit more muted. We've been through this before. We saw last week that there was one day where we thought the war was over and that the market rallied strongly, only to find out that it was continuing. So I think we will find the reaction here will be positive, and there will be a bit of buying, and I think investors are looking for that opportunity as to when do we actually pull the trigger and start to buy. But yes, I think until we actually see a real resolution, I think the Australian reaction will be a little bit more muted than what we saw in the US.
Yet no respite as far as fuel prices are concerned, despite the government bringing in that cut to the excise, and it comes at a critical time too as we head into the Easter long weekend. How are you seeing that play out, I guess, particularly for those exposed companies, earnings going forward?
Yeah, you're right, Andrew. It's certainly the big issue here in Australia is that fuel supply, not only the price that we're getting or having to pay at the petrol bowser, but also the actual supply around the country, and typically around Easter, and that Easter long weekend, as well as school holidays, is a big area or big time for demand. So that is something obviously the government is concerned about, and the investors are concerned about as well. So we've had a look at a lot of the companies directly involved. The likes of the transport and logistic companies will pass most of the costs on to their customers. We do like the likes of Ampol and Viva Energy, because they're the refiners and are going to benefit from not only the higher prices but also the higher refining margins. So it's likely that we get a little bit of weakness in the share prices of Ampol and Viva today. So there'd probably be a couple that we'd look at buying. We've got buy recommendations on both. Viva tends to stack up a little bit more attractive on a fundamental basis, but both are really good businesses. And then when we look down the path, our analysts have also just had a look at the major retailers, the Coles and Woolworths, and the impact that the fuel price will have on those. For food manufacturers, the cost of fuel generally is around 15 to 20% of their overall cost. For those transport and logistics companies, it's around 20 to 30% of the cost. So we see that there will be an impact for food inflation. It'll increase the cost of goods sold for Coles and Woolworths by about 2 to 5%, which should translate to about 1 to 2% in food inflation that we're all paying at the supermarket. So certainly from a consumer point of view, that's not a positive. But from the company perspective, the analysts haven't actually changed their earnings forecast because we think that there will be sufficient sales growth to offset some of that impact of the food inflation that we will be seeing. So we've maintained our accumulate recommendation on both Coles and Woolies, and we've actually got a buy recommendation on Metcash, which stacks up a lot more. Fundamentally, they're trading a lot cheaper than Coles and Woolworths.
And David, more broadly, how are you viewing, particularly the two largest sectors, the banks? They've proved to be volatile in recent days, and of course what we're seeing play out with those commodity-related stocks.
Yeah, we've actually done reviews of both of those sectors on a broad basis, taking into account the impact of what's going on in the Middle East. The banks, we haven't really changed our forecast there. The impact more locally is the recent interest rate rises that we've had, and I guess the prospect of further interest rate rises happening because of that inflation. It's difficult to find value in the banks. We like Macquarie. We've actually got a buy recommendation on them, think that they're doing well in a number of sectors, including getting more share of the home loan market against those majors. We like Judo Bank, MyState, some of those smaller disruptor type businesses. It's difficult to find value in the large banks at this point in time. And as far as the resources are concerned, I guess that's the area of the market that has had really strong earnings growth over the last 12 months or more, and we think that it actually is positioned quite well because commodity prices have been quite a bit stronger. So we've actually seen a few upgrades in those resource stocks, and we see that as being an area which should continue to do quite well in this environment.